In this new segment of Advisor Revelations, the DPL team will discuss how to evaluate new solutions and address current challenges and the strategies that can help you grow your firm and AUM.
Welcome to Advisor Revelations. My name is Willie Jones, and I am a lead consultant here at DPL and also head of our consumer division. Today, I have on the microphone my good friend and colleague, Logan Cheatham. Tell me a little about yourself, Logan.
What's going on, Willie? Great to be here. First podcast, so might be a little rusty, but very excited. Honestly, I think the best thing about being a part of DPL is I was actually in the broker-dealer space with insurance carrier in Cincinnati, Ohio, where I live. And one of the recruits actually reached out to me about DPL, saw it was an interesting opportunity being in the commission-free space, and actually reached out to some advisor contacts that I had. One advisor actually had a relationship with DPL, and another advisor said, if you want to be on the right side of the coin and going fee-based, then it's definitely a great opportunity. And I've been with DPL since May of 2022, and it's been a great year ever since.
Well, welcome. Great. We're going to cover a few topics today. A lot of them is really for you advisors, reasons why you want to add an annuity to your portfolio for your clients' planning. But first, I did want to remind you, please subscribe and also visit dplfp.com. Consultants are here all the time to answer questions. We have lots of tools and resources on our website. Please utilize those. We're going to look forward to working with any advisors out there. Now, as Logan and I were discussing it, we really talked about what is the impact of reducing a market drop. And a lot of that goes back to, in my era, the 2020 Black Swan event of COVID and what happened to people's portfolios and the 30 to 40% they had to recover, especially those people that were getting close to retirement. How could that have gone differently? Logan's going to talk about, what about even just 2022, Logan, just recently?
Yeah, I think the past 5 years, Willie, has been just pretty volatile for a client, especially entering that retirement phase. 2020, we had a drop. 2022, we had a drop. So we're 50-50 on this decade so far. And I think one of the things I've seen a lot from advisors when it comes to these big drops is looking at products that have principal protection or some level of protection in place. Just because one thing we've learned from advisors and stats say it's with time, staying invested is the most important thing. So how can we keep clients staying invested with their money so that can grow over time, but still being able to give them peace of mind that, hey, your money is protected if a big drop happens. And I hear a lot of my advisors talk about uncertainty this year with an election year. So we've been seeing a lot of flows to principal protected products, which I think is very helpful for a lot of clients. It's new strategies for advisors to be able to look at too. And I think a lot of advisors are buying into these strategies right now because of the timeframes.
Yeah, and think about it. It's also very difficult if you're a client, you're talking to them and they want to retire now or within the next few years. There's so much uncertainty in the world today. Like I said, the Fed has decided to change what they're going to do. We could be on the front of two wars. Just so much uncertainty out there. So having annuities and some principal protection and really trying to conserve what they have can be a big part of the retirement planning process. Now, one of the things that actually comes up is I think a lot of retirees are worried about outliving their savings. Are your advisors talking about that too, or?
Yeah, we see a lot of that, especially, everyone's saving up to retire. The whole goal with savings over this whole life is to be able to still get that paycheck in retirement, be able to relax, go to Cabo, wherever you want to, and how you want to live your life after you've done all these years of work. Everyone should get rewarded for that. And there is a lot of fear with my advisors and their clients about being able not to save, and being able to offer advisors a whole suite of solutions that can provide saving metrics to them is very helpful. And we see a lot of my advisors going towards 100% principal protected products right now, especially within the last 3 months. And I think that's very important because of just what we talked about, those big drops. You don't have to worry about big drops with 100 principal protected products, which gives advisors peace of mind when they're managing those other funds, sleeving off a part of their portfolio that's 100% principal protected. Maybe they can be more aggressive on the other assets that they hold, but you're also giving that peace of mind to a client. That client knows, hey, 20% of my funds aren't going to be impacted by a big drop. So I only have to worry about 80% of my money now. So giving peace of mind to people across the board to save in a more consistent manner has been very helpful with our products.
especially right now, take advantage of those higher rates. If you can look at your client and take that bond allocation and guarantee them 5 to 6% growth over the next 7 years, I think that's a huge part of their portfolio that they're going to have peace of mind on now. And exactly, Logan, they can be more aggressive on the equity side and maybe take a few more risks, knowing that I have some coverage over here just in case. So I think those are just brilliant you just brought up.
I think that's a great way to put it, Willie.
Yeah. And the other thing is, let's be honest, not all your clients are where they need to be either, and they're afraid of what the market is going to bring. I have seen a lot of my advisors now look more into what we call RILAs or buffered annuities to protect that accumulated savings, but yet they still need growth because they want to go to Cabo when they get retirement. I always tell people, you want the choice to be the stored greeter, not to have to be the stored greeter. So what are your thoughts on that?
Yeah, I think buffered annuities are a great strategy. I see a lot of my advisors utilizing buffered ETFs so they can already have a hedge against downside risk in the equity market. And I think using registered index-linked annuities provide a little bit more protection from a tax deferral growth standpoint. So there are opportunities on the annuity side of the coin to be able to do the same things. I think one beauty of the annuities and the buffered strategies versus the ETFs is you don't have to worry about those market value adjustments or those adjustments in the quarters. You get the rates that you get. You can tell your client, we don't have to worry about it. Just because I know in the buffered ETFs, depending on when you buy in the quarter, you might not get that full 10% buffer. It could only be 8.5, but it could also be 11.5. So there is some risk on that side of the point with timing the market versus on the annuity side of the coin. You don't have that worry with timing the market. You get what you get.
Mm-hmm. And the great thing about it, a lot of the buffer annuities allow you to lock in those gains. I mean, just the other day, I had a report come out where particular clients and advisors are in such annuities where they are to 90% of goal. They can go ahead and lock those profits in and then jump back in and capture some more. So there's a lot of flexibility around these I think advisors really need to look into.
And I think a thing that we didn't hit on is the liquidity standpoint. A lot of these products are liquid. I think that's one thing that's overlooked when you look at annuities is there's still some old school connotations. You're locking up your money 5, 10, 15 years, whatever it may be. And a lot of the products on this side of the coin, on the commission-free space, are going to be liquid within the registered index-linked annuity strategies and variable annuities.
So I want to point that again to all you advisors out there. Liquidity is here on the annuity side. That's no longer an excuse, and low cost, super low cost, because all the buffer annuities we're talking about now, almost all of them have no cost associated with them and they're liquid. Come on. All the reasons you say you weren't going to use are kind of falling by the wayside.
Yeah. And we're seeing more advisors lean into that now.
Yes. Actually, yeah, those early adopters are there. So don't be a laggard out there, advisors. One of the things we really do want to talk about, though, that I know I'm still seeing is people save all their life because that's what they were told to do. And then they get into retirement and they're told they're going to take all those savings and produce an income so they can live comfortably. What are you seeing as advisors? What's the best way to kind of approach that so you're doing what's right for the client? Because not everybody believes in the same thing. You know, we got some that like the 4% rule, some that like the total return rule. What are you kind of seeing out there and from an advisor and maybe even a client perspective?
Yeah, what I'm seeing when I'm working with my advisors is looking at what's the best for the client. Every client's going to be different depending on what their retirement strategy is. And I'd say one of the things that I lean most of my advisors to utilize is our retirement income style awareness tool. Reason being, that's going to do a lot of mental fact finding for the advisor to figure out how they want to handle retirement. Say they come back as a total return approach strategy. They're probably more fit for that 4% rule. So they're totally fine with optionality and probability in the market. But say you get a person that wants principal protection or protected income, well, that's an indicator that they want a pension style mindset for retirement. And so being able to provide an advisor with a solution that's going to be that pension mindset is really helpful just because just 2 generations ago, pensions were the normal. And now that's now on the consumer to provide that personal pension. And a lot of our advisors are utilizing annuities for that guaranteed income. I mean, heck, it was our most popular solution last year. I think we did $300 or $400 million just in income-driven solutions.
I tell people, don't let the word annuity dissuade you from using that solution. It is no longer a bad word. If it helps you, call it their personal pension. Or how do I get insurance or de-risk your portfolio? You buy insurance. It's the same thing. We have never said, hey, put all the money in annuity and get guaranteed income. No, but if I can get rid of 70 or 80% of their base expenses with only a slice of their portfolio, why not?
Yeah, exactly. If you're able to cover the expenses with just a sleeve of their portfolio, one, that's peace of mind that the basic needs are covered, but also that's more money you have as the advisor to invest more aggressively to grow those assets to create generational wealth and legacy. Because not only is retirement income a huge story, but it's a big story of how can I create wealth for the next generation?
Yeah, I tell people that creates a win-win for the client and the advisor when you do that, because by getting that slice of income done and then being more aggressive on their equity side, you're also growing your AUM, which, like I said, I'm creating that legacy for them, but I'm also creating more income for my firm. So yeah, don't discount annuities for that, because overall, I hate to tell you, advisors, people with annuities find more retirement satisfaction in retirement, because I don't have to worry about how the market performs. Am I going to get my same income because my bond allocation and equities are down? That affects my income. But guess what? With an annuity, it doesn't. Wouldn't you say that's pretty factual?
Yeah, I definitely agree to that. And that's why advisors are using income-driven annuities, is to have a base level of income that's already in place and plan.
Yeah, I reiterate the story I tell advisors now, going back to 2020. You had those that were using total return approach that have a lot of conversations with their clients, what's going on.
Yeah.
30% of your net worth is gone. But those that had a pension from a company, not as many as more, had annuities in place for their income, think about it. Their lifestyle didn't change. They kept exactly the same. Maybe they couldn't go on as many trips, but I wasn't worried about putting food on the table. And I think that becomes a big blessing as far as retirement satisfaction.
Yeah, exactly.
Now, one of the things that tends to come up every now and then is I talk to a lot of advisors that talk about positioning and delaying Social Security, but yet clients still might need income in that time that want to retire early. How are you approaching that?
One strategy that I've been seeing more from advisors is utilizing our MYGA products, those multi-year guaranteed annuities. And we've been kind of talking about it as a Social Security bridge. So we've been seeing more people want to retire sooner. It seems like the sweet spot's turning to 60 instead of 65 like it used to be. So for Social Security, typically to get your full benefits, you got to be 67. So how do we use your current portfolio to generate income in those 5 to 7 years? And what I've been seeing from some of my advisors is we have products on platform that offer that fixed guaranteed rate of return. You're able to sweep the interest of those accounts. So then you're able to create one income for that short time frame for 5 years. Your principal's still in place. So that money you put into the pot is still there. So you can add it back into your financial plan once that time is up, and you're able to delay that Social Security.
I think that's brilliant. And I have a real world example of a couple up in New York. He wants to retire at 60, and he's doing exactly that. He's taken about half of his portfolio and put it into a MYGA, and he's sweeping the interest monthly and creating an income of over $60-something thousand per year off of one of them, and another 30. So that's $90,000 a year, principal in place. He's getting about 5 to 6, and they're ecstatic because they didn't know this was possible. And I tell advisors that beats the 4% rule. So if you've taken care of that for them, everything else you have in income, or on the equity side, you can then be a little more aggressive and look for some huge buying opportunities out there to really just grow their portfolio overall, like you said, and help create that legacy wealth. Or if they don't have kids or legacy, that I want to take a cruise for a month wealth. Whatever you want to do, we'll be there for you.
Exactly. No, I think that's a great point, Willie. And I'm seeing more advisors lean into that strategy on my side of the coin.
Awesome. Any other points you wanted to touch with before we wrap up here?
Not that I can think of, Willie. I think it's a great time to be in this space. DPL is a trailblazer by being able to offer commission-free annuities. We're able to help anyone and everyone on that side of the coin, not just with annuities, but with insurance as well. And we're here to be doing the best for the advisor and the clients. Like, this is a new space still. It's only been around 6 years. We've had great growth, and I see more opportunity and upside to come. And I think it's a great time to have partnerships with DPL. And if any advisor has any questions, always feel free to reach out.
Yeah, I tell them all the time, there's a fundamental shift going on in the insurance industry for what the future will look like. Don't get left behind. I want to thank you guys again for visiting Advisor Revelations. My name is Willie Jones. That's my partner and friend, Logan Cheatham. We are internal consultants here. please subscribe and visit www.dplfp.com anytime, because we're here to help. Thanks, Logan.
Thanks, Willie. See ya.
All guarantees are based on the claims paying ability of the issuing insurance company. Thanks for listening. To hear more advisor revelations, go to dplfp.com and subscribe on your favorite podcast streaming app.